Hello, Maverick traders. Welcome out to your Option Foundations courses. This is Module 3, SPX versus SPY options. This is a class that we want to go through because a lot of people kind of consider, well, why would I use one versus another? What are the pros and cons to each? And what are maybe the most important questions of what are the mistakes that people make? And the big one is over leveraging, just getting too big, not understanding the risk and reward parameters. And it seems like some of these trades that should be very high probability are really enticing. Well, they can be disastrous, and we'll talk more about that. As always, just a quick reminder to if you're using any of these products, make sure that it fits in your plan and make sure that you have practice traded it, really considered all of the potential outcomes and building that strategy. So SPX versus S&P options. Let's start with the index itself. The S&P index is a market cap weighted index of 500 different stocks, but because it's market cap weighted, that means that it puts more weight on the largest market capitalization. So a company like Apple, for example, at a near $3 trillion market cap, well, it's going to have the biggest weighting in the index. And Microsoft and Amazon, they make up the majority. Apple, for example, at 6.8% of the index, is larger than probably the bottom 50 stocks combined because they're all 0.01 or 0.05 or 0.10 or whatever. They're such a small portion of the index that Apple has a big impact on what the S&P does, and Microsoft has a big impact, and those bottom 100 stocks, they don't move the needle too much. So definitely heavily weighted towards the larger stocks. As you look at the S&P 500, you can kind of see how it transpires, trends and momentum, and it trades like anything else. We could be putting on trades to profit from these price moves as it moves from 4,700 down to 45, 45, back up to 47. We're looking for trading opportunities. There can be periods of high and low volatility. Part of the reason that people might find trading an index interesting is because, well, you've got that instant diversification. This stock has really bad news and it's down 5%. This one has really good news and it's up 5%. And those things offset and the index didn't move. So, there can be an advantage to that. But remember, risk happens fast. And a lot of times in the higher volatility environments, correlations go to 1. So you can have periods of time where 90% of stocks are down. Everything's going down. The entire index is going down, but it was priced not to have that type of movement. So it gets you into trouble because the index is not expected to move as much, and yet it does on occasion move much more than was priced into the options. The S&P ETF, SPY, this is created by State Street. This basically is a tracking device. It's an ETF, still controls and holds those stocks, but it's 1/10 the size. So all the same kind of considerations, same weightings. If you buy and trade SPY, still 6% of the ETF is Apple, 6% of it is Microsoft. It's the same basic composition. And you'll notice that if you were to look at SPY and the way that it trades, it was identical to SPX. The same setups, same opportunities, same type of moves in essence. Now, it won't always be perfectly linked. Like if SPX is down 1%, SPY might be down 0.098 or 1.01. Like it'll be off just a teensy tiny bit, a couple of pennies here or there. But for all intents and purposes, they're the same thing. So it's just 1/10 the price. That's the big difference. Is it's a smaller price, therefore it's a lower risk to reward. But overlaying their charts, if you just took the prices away and you said which one's which, it's probably going to be pretty hard to tell which one's which. Their charts are going to look pretty much identical in terms of how they trade. There will be tiny differences that we'll consider in terms of the style. what style of options are these? Are these European style? Are these, American style? And how does that differ? But you'll kind of see here that as they move, I mean, it's just pretty much the same chart. And that's what we want to represent. You're not really trading something different from one to the other. If one's up 2% on the day, the other's probably up 2% on the day or very darn close to it. Now, index options, there are some differences, and this gets into the way that they trade. So when you trade SPX index options, they're a very popular vehicle because they're large in size. So big institutions will trade SPX indexes because it would take 10 of SPY to get them one of SPX, and they're managing millions upon millions of dollars, right? So if they want a big size position, well, the index is what they're going to look for. For smaller traders, though, that doesn't make the index necessarily as valuable for you. The index might be a little too large in size, depending on kind of where you're starting at and what you're trading. The multipliers and effects are pretty much the same. The indexes do not trade in penny increments. It's 0.05. So what does that mean? Well, if you were looking at the options, it would trade at $20.10, $20.15, $20.20. They wouldn't be trading at every penny like the SPY options. SPY options would trade at $2.08, $2.09 in penny increments, but still the same multipliers of 100 and such. Strike price choices, there won't be as much. You'll notice if you look, there's $5 distance between the strikes, whereas with SPY, you'd have dollar increments. An SPY would have even more than $1 increments, a lot of times every 50 cents. Like SPY would have a 437 strike, a 438, in some cases even a 438.50 or something. A lot of strike price choices. Now, there's really two types of SPX index options. There's the monthlies and the weeklies. Both of these settle in cash, but they're a little bit different in terms of their expiration. So the monthlies are the original contract. This is kind of the original guy, right? SPX weeklies have only been around, I don't know, 10 years, but they haven't been around forever. The monthly contracts trade kind of oddly. Like if you see an SPX contract, it would have, like a lot of times here, it says it's an April 13th expiration on the monthly. Well, what's weird about that is the last trading day is April 14th. So why does the monthly show April 13th as expiration? What it's telling you is that's the last day you can trade it. The monthly contracts, they'll have a final trading day, which is the day before settlement. The settlement is based on whatever the opening value is on expiration. So the monthlies, usually the expiration is the third Friday of the month, and it's Friday mornings open. Whatever the S&P index is valued at on the third Friday morning opening. So you don't even really have a chance to trade it. You had a chance to trade it on Thursday, and then you're just at the mercy of the gaps. I suppose you could use futures or something, but basically you're at the mercy of whatever gap happens and whatever it's valued at. They establish what's called a set price, and this is published at the CBOE website. This is the settlement value. So if you were trading a monthly option, your last chance to trade out of it would be Thursday. And then on Friday morning, this week's a little weird because markets are closed on Friday for Good Friday, but this is how it normally works. Friday morning, the market opens and there's a settlement value. It's not even, they'll calculate what the actual settlement value is. Then every contract is settled based on that settlement value. So let's say that the index is worth, the settlement price comes in at 4,412 or whatever. Well, that would mean that all of these calls are in the money and it would mean that anything above 44.12 is out of the money and expired for zero value. And the settlement would be, well, these options get settled at $2 because there's $2 in the money. These would settle for $7. These would settle for $12, and on down the line you'd go. It would be the contract is settled for whatever it's in the money, its intrinsic value, based on the settlement value that is established. So it's just a weird contract. That's how they built it. You can trade it through Thursday, and then you're at the mercy of whatever the settlement value is on Friday. They created these weeklies to kind of fix some of that, I suppose, because people said, we don't love that. You know, the gap, you might be in a great position and then it gaps on Friday and you're like, I can't believe it. The settlement was terrible and I lost all that value or whatnot. So the weeklies trade a little more standard. These trade through Friday, through the expiration, and they settle based on the expiration's closing value. So wherever SPX closes in value on its expiration, and it doesn't always have to be a Friday. Now they've got Wednesday options, they've got Monday options, but it's the closing settlement. And it's a cash settlement. So again, whatever the SPX closes at, well, that's what these would be worth. So again, let's say that it settled at, 44, to change up the number, 44.08. Okay, well, all of these calls expire worthless. This one's in the money by 3, so it would have a $3 settlement. This one's in the money by $8, so it would have an $8 settlement, and so on. And who gets what? Well, if you're long the option, you get that money paid back to you at settlement. That's its value. You might have lost money, by the way, but you get that money back, that intrinsic value paid back. If you're short the option, then you pay out that at settlement. That's how much the settlement is. So all of these contracts settle out like that. Now you can trade in and out of them and avoid settlement, right? I could buy and sell these options way before expiration hits. But if I hold them into their expiration, then they settle in cash based on whatever the settlement value is. In this case, the settlement on expiration morning, or on these, the settlement value is based on where the SPX closes that day on its expiration. It's no longer tradable after that close, and you just get the settlement value. So European style options are just different. They cash settle. There's no exercising and taking stock and so on. With SPX, it's just an index. It tracks the value of those. It's not actually holding all of the shares, and there's not shares to be delivered and so on. It's just cash settlements. If if you're in the money, then it settles in cash. If it's out of the money, it expires worthless, and on it goes. And they just settle out for cash every time. The expiration date, well, this will expire on the opening tick of the third Friday of the month for the monthly options. Margin required, well, one contract of SPX will basically be equivalent to 10 contracts of SPY, right? Because it's 10 times the size. So trading one SPX contract is basically the same as trading 10 contracts of SPY. Now, if we look at SPY options, they're just stock options. So they're things that you're probably more familiar with. These will trade in 1 cent increments, same concepts, in the money, at the money, out of the money. Trading hours, a little different. Trading hours, they do stay open for a little bit of an extended period after the market close. So that's a little different than your stock options. If I'm trading options on IBM, well, they close at 4 p.m. Eastern time. With SPY options, they actually have a little extended period where they trade. Now, these are American style options. So, exercise is possible. That means that any in the money contract will exercise over its expiration and shares will be delivered. This is not cash settlement with SPY. Actual shares are delivered. Now, of course, I could always just trade out of the option. I don't have to have shares delivered, but that's the process. If I, trade those options, well, they settle in an actual settlement of stock if I don't close the option before expiration. Expiration dates can be Mondays, Wednesdays, Fridays again. There can be monthlies, there can be quarterly options. How those work, how does a quarterly option work? Well, they always put those expirations at the end of a quarter. So for example, the last trading day of March would be when these quarterlies expiration is. That doesn't have to be on a Friday. If the last trading day in March is on a Wednesday, well, then that's when that quarterly option will expire. It will have its expiration at the end of March, the last trading day of March, So there's different expiration dates to choose from. Margin requirements, well, again, margin is equal to the max risk on the position. If you're trading some $5 spread, well, you're tying up about $500 of capital, the typical approach. Of course, these are 1/10 the size of SPX, so they're going to tie up a lot less capital. They're going to have a lot less risk accordingly for the same type of position. So while these look similar on the surface, we have seen traders get into trouble in SPX options. I'm going to take you through a little bit of my history. So most of you probably know I started, 20 plus years ago. I went through the traditional route, got licenses, eventually worked my way up the ladder. I was a Series 4 options principal, which is the head of option trading at the firm. Did that for a number of years. This was years ago, started a program trading SPX index options. And at the time, it was wonderful because not every Tom, Dick, and Harry was doing it. And I would do this approach where I would sell options and generate income. And it was a very, profitable endeavor. It was an alpha. Like, we had huge success with this program of trading these short-term options. And roughly, I would say maybe 7 or 8 years ago, things started to change dramatically. They just did. The value opportunity of shorting short-term options in SPX and taking advantage of premiums and time decay and so on is started to go away. Basically, you had a situation where you were one of the only ones doing it, and now all of a sudden it had so much popularity that you're stacked up with all these other individuals, and everyone's trying to sell short-term options. Everybody, everyone and their dog, their brother-in-law, their sister-in-law. And now you're competing. And there's this huge competition to sell these short-term options and try to profit from these premiums and so on. And I basically stopped doing it a handful of years ago. I used to trade. They didn't have so many choices. They didn't have, SPX weeklies that expired on Mondays and Wednesdays, but it's all part of the same problem. If you have mountains and mountains and mountains of people all trying to sell options, well, what do you think happens in that circumstance? What's the supply and demand like? What's the problem with this? So you'll hear, there's all sorts of programs that try to sell you on, sell these short-term options, make money. It's so easy. High probability. You can put on this trade and it'll have an 80%, 90% probability of success. That's all the stuff we were doing, 10 plus years ago. Now you're competing against literally thousands and thousands, hundreds of thousands, including institutions that have tried to sell this to investors. It's a mess because now you have all these people trying to sell. So it just depresses the option values down to nothing. Think of it like a bookie. Think of it like Vegas. Let's say that, over-unders, they set a line on how many points should be scored in the game. And they say, okay, well, this NFL team usually scores 20 and this one scores 25. And we think this will be a standard game. Okay, over-under is 45 points. That's where we would That's where statistically it should be. But let's just say for some reason you have gobs and gobs of traders, bettors in this case, that just want to bet the under. Okay? Every time they just come in and pile on. And so Vegas starts setting the line way down lower. They say, well, we'll just put it at 40. And it doesn't even matter how low they set it. These guys still come in and they bet that it's going to be under that. So even though Vegas has pushed this line down dramatically, they say, well, we're going to bet lower than that, which makes no sense. The game's probably going to finish close to 45 points. And even if it's a low scoring game, well, it comes in at 42. And all these people are betting it's going to be below 40. Why? Well, because they're all piled up and they're just ready to do that no matter what. That's essentially what's happened to these short-term options. And because you have so many people trying to sell them, the short-term option values have eroded down. So there's actually alpha. There's probably opportunity to be a short-term option buyer much more than a short-term option seller, to be quite frank. This is what I have experienced, and I have done this for a very, very long time. I bet I've traded more of those spreads than probably the majority of anyone you've ever met. Let's put it that way. And that's what I've experienced and pretty much know to be true. You can see it in the data. So here's kind of the approach. People like to do these types of trades. They say, I'll put on these high probability, short-term expiring, sell this way out of the money spread here and sell this way out of the money spread here and collect some premiums on this. And by the way, there's commissions and other factors involved. And so they're putting on quote unquote high probability. But the problem is yeah, their probability of success is pretty good. Because normally if you put spreads on way out of the money, they're going to expire. But you're not collecting enough premium to make it worthwhile. And if you're collecting a lot less than you should be, there's also the other times where statistically it is going to go this way. And now you're in a world of hurt because you didn't get paid enough on all the times it should have worked, and it did work, to compensate for the times it doesn't. And you'd have to be the ultimate hedger. You'd have to figure out how to really offset these times where it's going bad and not take losses if you're not getting paid what you should be. So this trader says, well, I want to make $1,000. So he makes, $1,000 on this trade by trading 5 contracts. He gets paid a $2 premium times 5. Okay, bring in $1,000. Okay, great. Well, this is a risky trade. You got $30 of risk, one side or the other, not on both. You can't lose on both sides, but $30 at risk, $200 of profit versus that. Well, it's a pretty nasty scenario where if the trade goes bad, you lose a lot. If the trade goes good, you make a little. And that's what selling out of the money, way out of the money spreads is it's collecting small premiums for big risk. That's simply, what it is. You're picking up nickels and dimes to try to avoid dollars worth of losses. And so that's the risk to reward of this type of trading, of selling way out of the money spreads. Yeah, high probability. We could say every time you do this, you're probable, as you start off, you're probable to succeed. But you've got to be probable a lot. If you just take one max loss at 2,800, that wipes out, divide that by 200, that wipes out 14 profits. So one max loser would eliminate 14 times that you did that for a profit. Then if you factor in the commissions and so on, it probably wiped out 15 profits. Just one max loser. If you experience a couple of max losers in a short period of time, and now you're deeply in the hole. And so it's not that it doesn't have a high probability. Every time you do it once, you're likely to succeed, but you're not just going to do it once and be done. You're going to do it again and again and again, which means some of these are looming. right? So SPY, couldn't we create basically the same type of structure? Sure we could. We could do some $3 wide spread instead of 30. See how it's 1/10? We could collect a 20-cent premium instead of 200, and same thing. You're trying to make $1,000. Okay, 1,000 divided by 20. Maybe you have to do 50 of these, 50 contracts of these to bring in $1,000. So would you make a 50 contract trade? This is the big problem that we see people make is if they did the math on it, they'd go, holy smokes, 50 contracts of SPY, that seems really large. But 5 contracts of SPX, that seems reasonable, and they're not paying attention to the math. 5 of SPX is 50 of SPY. It's the same thing. 50 feels big, 5 feels small, right? But really, you should be much lower than this. If you're going to play this game, you probably don't feel comfortable with 50 SPY, and that's probably a good decision. Maybe you feel comfortable with 10. Okay, well, then that means you could trade one of these to be in the equivalent position, because 10 contracts of this spread is the exact same as one contract of this one. And that's the point. If you wouldn't be willing to trade 100 contracts of SPY, but you're out there doing 10 contract size in SPX, well, that doesn't make any sense. It's the same thing. It's the same effect. So the key concept here, following proper position sizing methodology, will make both trades the same size with the same max gain and same max risk. And of course, you kind of get what you pay for in that if you want, it's a teeter-totter effect. Naturally, if you look at the teeter-totter, if you want to stack high probability up here, you're going to have a really bad looking risk to reward down here. That's the nature of it. They don't give you 90%, 80% probability of success and then also give you some massive reward with very little risk. No, that's not how it works. If you want to have high probability, then you're going to make a small reward. You're going to make the nickels and dimes to try to avoid the dollars of losses. That's the nature of it. And so if you are going to take this approach, and we have traders that are just set on it, they say, this is what I'm going to do, and I'm going to try it out, and I'm going to believe in it, and maybe I can do it. Well, let me suggest that, again, I've traded these concepts for many, many years. If you're going to put on this high probability where you have a super high risk number and really small reward, the only way I believe you can do that effectively is to learn some approaches towards delta hedging, towards basically ways that when it goes bad, you're basically pulling a lever to reduce your delta risk, because that's what kills you. The delta starts at a small number and it grows and grows and grows, and by the time this thing's in the money, you got a big messy situation. You can do things to where you do mitigate some of that risk, and it won't probably eliminate all of it, but let's just say you had $100 of profit for 900 at risk, a smaller reward, bigger risk, high probability. Well, if it starts to go this way, you need to have and know how to do some things. Like, I would prefer trading SPY for probably this reason. You can short SPY to hedge your SPY position. So let's say that you had some bull put spread down here that's hurting you. Stock's going the wrong way and it's heading that way. I could short SPY to hedge that. And if the stock was going up here to hurt a bear call or something, then I would buy SPY. I'd go long it. And you'd basically match up some deltas. Watch our delta hedging video, because it's the only way that I think this can work. Now, if you do that, you can short a few shares of SPY. It takes your net delta down. And what you can do is hopefully work this into a smaller loss, where on the really bad ones, you know what? I took a $300 hit. If you can do that, if you're a hedger to where you make $100, the next time you do it, you make $100, the next time you do it, you make $100, the next time you do it, it's going the wrong way. Okay, I only lost 300. I make 100, I make 100, I make 100, I make 100. It's going the wrong way. I lost 150. I make 100, I make 100. Oh, going the wrong way. I lost $50. You can work your hedge into a lesser risk position. So when I trade these high probability spreads, this is my go-to. This is absolutely my go-to. Now, why does delta hedging work? What's the concept there? Well, delta's the killer. Delta's this big monster that's hurting you, and so you need to take your net delta down, but you still get to profit from the theta. Remember, these are time decay trades. You're shorting a spread, you're profiting as it decays and expires worthless. So you still get the theta, but you get to negate the delta effect, some of the price movement. So as the stock tumbles this way, your short stock makes some money to offset the losses in your original spread, or at least part of it. It doesn't mean you're going to be successful. It doesn't mean you're going to be profitable. But if you can take what was a $900 max risk and take it down to 200, take what was a $900 risk and take it down to 150, you're going to stack up a lot of these profits. That's the nature of a high probability trade, but you got to do something. You just have to figure out how to not take those max losses. If you sit there and take those max losses, it's going to be a problem. Let me say, delta hedging, I'm a big fan. I've also seen people try the whole rolling effect. They just try to roll and roll and roll, and that does not work. That's basically martingaling. Martingaling, if you're not familiar, is the gambler that says, well, I'm going to try to make $1. So he goes and bets on red and it comes up black and he doubles his bet and he keeps trying to do that, right? It's why they set position or bet limits in Vegas. So you can't just sit there and keep doubling until you make $1. But rolling is kind of that effect. But each time you roll, you increase your risk. That's the nature of it. And if you go do the math, you'll see. So some people think, well, I'll have a bull put spread, but if it starts to hurt me, I'll just roll it out in time and collect more credit and I'll get more space. Well, it doesn't solve the problem because a lot of these just keep going and these become bigger and bigger problems. So it sounds good in theory. It's not so good in actual practice. That's something you're going to have to test, but if you think you can just roll it to infinity and have it work out, it's not really how it works. That's not been my experience. Now, in summary, hopefully you understand how SPX options settle. They settle in cash. They settle, the weeklies settle based on the closing value. The monthlies, kind of a weird, the final trading days the day before, and then you just get the settlement value of whatever it is at the open. SPX and SPY are looked at pretty identical. I mean, that's what their price moves do. SPY is just 1/10 the size. SPX options have more flexibility, but carry much higher risk if you're not careful, because it's easy to kind of justify, well, it's only 5 contracts. Well, only 5 contracts of SPX is a 50 contract position in SPY, which obviously that sounds a little scarier when you put it in those terms. Always follow proper position sizing methodology, and hopefully this gives you some insight into what has happened and what has transpired over time to change the markets. And that's just the nature of markets. When something becomes massively profitable, like that has become, or it was the profits originally, well, it drives attention. And now that there's all this attention and everybody trying to do it, well, it's basically taken away the profitability. So now you have a bad over-under bet, and yet people keep betting it, and hoping and expecting to succeed, and it puts them in a bad position for profitability. So hope this was helpful. Have a great rest of your day. And as always, with any questions, let us know. We'll see you next time. Goodbye, everyone.